So today I'm going to explain you what that is the chartered accounts accounting process part 2, that is accounting process. First chapter, basic accounting procedures and some of the journal entries you will learn in this chapter. So accounts, it has two types of accounts. One is personal accounts, another one is impersonal accounts. In personal account, it will be three types, that is natural and artificial, that is legal and representative. In personal account, it is two types, that is real accounts and nominal accounts. Now double entry system. First let us know about double entry system. So double entry system of accounting, it is more than 500 years old. So more than 500 years old with double entry system is old. And Luca Pacioli, who is an Italian friar and mathematician, who published some of the arithmetic, geometric and proportionality, some of the theorems. Now it is called as proportionality, but that time it is called as arithmetica, and many other things he found. And then by the help of that, the accounting has grown. And the first book that has some information about double entry accounting system is Double Entry System of Bookkeeping. It has emerged in the process. Of evolution of various accounting techniques. It has by this double entry system you have made various accounting techniques has been evolution by this accounting process. Next, it is the only scientific system of accounting. It is the only scientific system of accounting. And according to this double entry system, every transaction has twofold aspects. Every transaction has twofold aspects. One is debit and credit, and both aspects, sometimes there may be both, or sometimes there is one debit and credit. They are being recorded in the books of accounting, and therefore in every transaction at least two accounts are affected. In every transaction, if you see. Now, to understand this double entry system, let us take some example. On purchase of furniture, either the cash balance will be reduced, or liability to the supplier will arise. There will be liability to the supplier, and new asset furniture is required, asset. This has been made clear already. It has been made clear already. And the double entry system records both aspects. It records as assets and liability, both aspects. And it may be defined as the system which recognize. It is defined as the system which recognize and records. It records both the aspects of transaction, whether it may be assets or liabilities. It recognizes and records it, and this system has been proved to be systematic and has been found of great use for recording, and it is been found as great use for recording the financial affairs for all the institution that requires the use of money. Now you learned what is double entry system. It records both assets and liability, their credit or debits, or both. Sometimes it records. Now, what are its advantage? There may be some advantages. No, that's why we are choosing double entry system. So, first use of double entry system is, by the use of this system, the accuracy of the accounting work can be established. What will be the accuracy of the accounting work done by that company? Through the trial balance, you can know what is accounting work, what is the accuracy of the accounting work. Through trial balance, you can know. Next is the profit earned or loss suffered during a period can be ascertained together with details. So both the profit and loss can be understood by the help of this accounting process. Next, the financial position of the firm or the institution concerned. The institution can be ascertained at the end of each period through preparation of balance sheet. So what is the position of that company? You will know by the preparation of the balance sheet. Next, the system permits accounts to be kept in as much details as necessary and therefore affords significant information for the purpose of control. So the system permits accounts, it gives accounts some of the to keep some much detail that are necessary and that are important information for their control and many other things. Next, results of one year may be compared with the previous year, and reasons of the change may be ascertained. There may be compared with previous year, or this year profit can be compared with previous year, and there may be some change we cannot know. Account. Now next is account. So we have seen how the accounting equation becomes true in all cases, how it becomes true in all cases. You have seen till now, till in the first part 1, that's 10 chapters, 9 to 10. In that you have learned what all the more information accounting equation. So you learned. Now a person starts his business with 10 lakh rupees capital. He has capital and cash, or both capital and cash both are 10 lakh. Keep like that. Transaction entered into by the firm will alter the cash balance in two ways. It will alter the cash balance in two ways when the transaction is written in the accounting. One will increase the cash balance and the other will reduce the cash balance. There will be increase and decrease in the cash balance. Payment for goods purchased for salaries and rents, many other things will be there, that will be reduced. The payments what you have made, it will be reduced. And sales of goods, goods you brought by giving the money, that goods that you sell and the collection from the customer, it will increase increase the money. You will get the money. Here you will spend the money for buying that goods. So we can change the cash balance with every transaction. With every transaction that happened, like if you buy the goods, you will reduce the money. If you if you if you buy the goods, you will get the money. Or if you buy the goods, you will give the money. If you sell the goods, you will get the money. So there will be change in the transaction. Instead, it would be better if all transaction that lead to an increase, if all transaction that lead to an increase in or can be recorded in one column. If we to record all the transaction in one column, it would be very good. And those that reduce the cash balance, the transaction that reduce the cash balance, that reduce your capital, that reduce the cash balance, that you should be recorded in the another column. You should make one for transaction what all happened and another for cash balance. Then the net results can be ascertained. The net results can be ascertained. You will not know about the net results. If we add all increases to the opening balance of cash, if we add on, it will be increased to opening balance and of cash, and then you have to deduct the total of all decreases, what all the amount you have less you got. As you know, one is for transaction and the other is for cash balance. Transaction you will get more because you have sold the goods, so you will get the more. Next, minus with the cash balance. So that's at the end what you get the balance, and minus it with the capital, like 10 lakh you have got, you have earned 11 lakh totally. When you minus, you will get 1 lakh profit. Like this you will earn. The two columns which are referred above, you can put usually in the form of an accounting. You get the two columns, that is, one is the transaction, another is the cash balance. The two columns there, I said no, that you will put in usually in the form of an account. In the form of an account we will put that columns, and that is and that column is called as the T form. It's like, see here, one is the cash balance, another is the one is the transaction, another is the cash balance. So opening balance in the increase receipt or the transaction. So 10 lakh, one is 10 lakh, another is 2 lakh 50,000, another is 2 lakh, another is 5 lakh, another is 1 lakh, and another is 4 lakh. Total 24 lakh 85,000 is the profit, is the amount you spend. Now in the decreases, you will decrease 1 lakh for some money, and 3 lakh, 2 lakh, 5 lakh, and in final 12 lakh and 1 lakh 85,000. Like this, totally you will close the balance. You will get both this balance 24 lakh 85,000, both are balanced. Since each T account shows only amount and not transaction description, it shows you each T account, or each means both. It shows you only the amount, how much is transaction you have made. It does not tell you what is the purpose of making that transaction, why you made, to whom you made. It does not give you any information in description. So we key each transaction in some way. We have to key each transaction in some way, such as by numbering. See here they have given number 1 2 3 4 5 6 7 8 9 10 11, like that. If you have to number, or however one can use date also for this purpose. One you can use date, this transaction has happened, you can use. What we have done is to put the increase of cash. We have put the increase of cash on left hand side, and we have put the decrease of cash in the right hand side, and the closing balance has been ascertained by deducting the total amount of paid, that is 23 lakhs from total left hand side. Such a treatment of receipts and payments of cash is very convenient. So here we talk about only one account, namely cash. Now let us see how to make T accounts when assets as well as liability are affected from some of transaction when it is affected. So now another is here. Initial investment by owners. The investment is 25,000. Like this you have to keep. Okay. The owner has did 25 lakh investment. This will affect two accounts, namely cash and capital. The asset cash increases and the stockholders equity paid up capital also increases. So cash you have paid is 25 lakh for getting that product. Capital, how much you have invested is that also 25 lakh. Like this you have to increase here. You have to interchange, you have to see for which you have paid. Next question they have given, paid cash to the creditors is 14 lakh you have paid for the creditors. This will affect cash account, it will decrease, and creditors account, which is a liability, will also decrease. So in question they have given cash we have paid, and it will decrease. So therefore here increase you should not put there, because here they have given increased, here they have given, but here they have asked decrease. So you have to interchange. What you have to do means, the effect of cash account which will decrease, you have to put in here 14 lakh. Next, creditors account, which is liability, will also decrease. So here here you have to put, so you have to interchange. Increase first you have in cash, it will come increase decrease. In capital it will come decrease increase. In creditors it will come decrease increase. Like that you have to think. So the proper form of account is like this. First you have to write date, particular, sum of the reference, and how much amount. Next, date, particular, sum of the reference, and how much amount you have taken. So the columns are self-explanatory, except that the column for reference is meant to, and the column for reference it is meant for indicate the source where information is about to enter the reference, whereas in the some information, little bit information you will write. Next, after the account, next is debit and credit. So we have seen that in T accounts, increase and decrease entries are made on the left and right side. Okay, in T accounts you make increase in left and decrease in right side, right of the accounts assets respectively, and vice versa for liabilities. But formally, accountants use the term debit. They use the term debit, D, or to denote an entry on the left side of any accounting. On left side you will denote the debit, and credit is denoted on the right hand side in accounting. Okay, in now there you learn T accounts, but here you are learning about debit and credit. So debit and credit you should be like this. It will be assets is equal to liability plus capital, or it will be capital is equal to assets minus liabilities, like this formula. To understand this equation more better, let us more expand it. Let us know more about it, about this equation. See, assets equals to liability plus stake stockholders equity plus stockholders equity, like this. Let us take assets is equal to liability plus stockholders equity. It has contributed capital, beginning retained earnings, revenue minus expenses minus dividends, like the city. This may also information it has. Now contributed capital, it is the original capital introduced by the owner, the capital given by the owner. Beginning retained earning, so previous earning that not distributed to the shareholders. The previous earning what you got by the taking, after taking the money from the shareholders, what you got the earning, that earning if you have not distributed you have to add that also. Next, revenue, so generated from the ongoing activities in the business. Expenses, cost incurred for the operation of the company. Dividends, earning distributed to the shareholders of the company. These are the information. So now we have also seen that if there is any change on one side of the equation, there is bound to be similar change on the other side of the equation. So if there is one change in one side, there will be change in another side also, or amongst items covered by it, or an opposite change on the same side of the equation there will be. Like let us take an example. See, here example is transaction. They have given started business with cash 10 lakh, total asset 10 lakh, owner's capital is 10 lakh. We have not got any liability. Borrowed 5 lakh, borrowed is 5 lakh because it is liabilities we have borrowed. Next, withdraw cash from the business 2 lakh. It is minus because we have withdraw, so therefore it is owner's capital because owner is giving, we have from owner only we have taking that capital. Now loan repaid to extent of rupees 1 lakh, so loan repaid, so it goes to liability because you have taken the loan from the bank. So 1 lakh minus 1 lakh, so brought furniture worth rupees 3 lakh, so plus 3 lakh and cash you have is minus 3 lakh. So this will not go because you have brought it, you have not taken money from the owner or from any bank loan or any from borrow, you have not done. Next, finally here total assets will be 12 lakh, liabilities will be 5 lakh minus 1 lakh because here 1 lakh goes for loan repaid and 5 lakh you have borrowed, so therefore 4 lakh. Owner capital, owner has given 10 lakh and minus 2 lakh you have withdrawn from the cash from business. For business you have withdrawn 2 lakh, therefore totally 8 lakh. When you add both of these you will get 12 lakh, like this balance. See, like this you have to. We have been seen previously what has been given in the is in the above chart is suitable only if the number of transactions is small. If the number of transactions is small, it is suitable. See here, only small number of transactions, 5 or 10, you can do till 10. But if there is a large number, not 5, 10, if there is not 5, here 5 or 10 is there, and here number is only 3, only less numbers of transaction here. But what if there is more number of transaction, and a different procedure of putting increase and decrease in different columns will be useful. So in new columns, more columns you have to make, so that you can put the decrease and increase in different column. Like see, total asset is 10 lakh and second is 5 lakh. Here you have decreased 2 lakh and 4 lakh, you have 1 lakh you have decreased. Total amount from assets is 15 lakh, decrease is 3 lakh. Total balance is 12 lakh because 5 minus 3, because 3 lakh you have decreased and 5 lakh is the amount you had. In that 3 lakh you have decreased. Okay, totally 12 lakh. Liabilities, final liabilities. Liabilities, it is also 1 lakh and 5 lakh because you have borrowed it, like that you have keep. Okay, totally 5 minus 1, 4 lakh. Next, owner's capital. Owner's capital increase is 10 lakh you have given and 2 lakh is decreased. Totally 10 minus 2, it will be 8 lakh. And when you add 8 lakh and 4 lakh, how much it will be? 12 lakh. So therefore balance sheet is balanced. No extra money or less money. Next, it is a tradition that increase in assets are recorded on the left hand side and a decrease in them on the right hand side. So increase in assets, if it is happened, then it is recorded in the left hand side. Decrease, it is recorded in the right hand side. And in the case of liabilities and capitals, increases are recorded in the right hand side. In the case of liabilities and capital, increase is recorded in the right hand side and decrease on the left hand side you have to do. When two sides are put together in T form, when two sides are in the T form, it is there, and the left hand side is called as the debit side, it is in T form, and the right hand side is the credit side, as you know learned about debit and credit. When in account a record is made on the debit or has debited the account, similarly to record an amount on the right hand side, it is to credit. The right hand side is credit and the left hand side is debit. Okay, you have to not say debit side like that. Left hand side is debit, right hand side is credit, like that you have to say. Now from this the following rules can be obtained. From the above, this following rules can be obtained. When there is an increase in the amount of an assets, there is an increase in the amount of assets, its account is debited, the account will be credited. If there is a reduction in the amount of the assets concerned, the amount of the asset that is concerned, if there is any change, suppose a firm purchases furniture for rupees 8 lakh. For rupees 8 lakh, the firm purchases some of the furniture. In the furniture's account will be debited rupees 8 lakh. Since the asset has increased by the amount, suppose the later the firm sells to extend 3 lakh, the reduction will be recorded by crediting in their credit. See, increase, first you have taken you have decided as 8 lakh we will give. The firm has decided they will take 8 lakh. Next the firm has decided, okay, we will you are taking a huge furniture, so we are reducing you 3 lakh, we are giving you reduction of 3 lakh we are giving. So 8 minus 3 will be 5. So therefore balance, total amount will be 5 lakh. Balance, it is balanced. Like that only in the next question they are asking, if the amount of a liability increases, if the amount of that liability it increases. Okay, the increase will be entered on the credit side of the liability account. On the credit side you will write the increase, and the account will be credited. Similarly, a liability account will be debited if there is a reduction in the amount of liability. Suppose a firm borrows 5 lakh from Mohan. Mohan account will be credited rupees 5 lakh is now owing to him. If later the loan is repaid, Mohan account will be debited since the liabilities no longer exist. So here you are giving money and taking money, so therefore Mohan first you have to take decrease. So decrease is 5 lakh. Okay, in second question decrease is 5 lakh because you are 1 minute. See, because they are asking you as liability. So liability, for what happens in liability, there will be first you will get decrease, then you will get increase. In assets, first you will write increase, then you will write decrease. How much is decreased, how much is increased, you will write. In the assets, liability, what you will write, how much is decreased, how much is increased, you will write. Because here you are giving money, then you are taking money. Okay, in assets what you will do, you will first take the money and give it back, whether it may be loan or anything. So you are giving 5 lakh. Okay, that decreases. Next he gave you back 5 lakh, so therefore increases. Both are equal, same, the question is finished. Simple. Okay, it is simple question. Now see, next question. There will be an increase in the owner's capital. There will be increase in that owner's capital, that is recorded by the crediting the capital account. By crediting the accounting capital, the owner's capital is written. Suppose the proprietor introduces additional capital. He introduces some of the additional capital. Okay, the capital account will be credited. The capital account will be still credited. If the owner withdraws some money, if the owner he takes down some money, makes a drawing, then the capital account will become debited because he is taking the money out. Before the money was coming for him, so therefore it is credited. But now he is taking the money out, so therefore it is debited. Next, profit leads to an increase in the capital. So profit, it leads to an increase in the capital, and a loss, it leads for the reduction. Okay, as you all know, profit leads for increase and the capital, and loss lead to the reduction. It is a common idea of business. According to the rule mentioned here in the above, profit and incomes may be directly credited. Profit and incomes, it will be directly credited to the capital account, and losses and expenses may be similarly debited. See, you have got profit, it will be directly credited to the capital account, but losses and expenses will be written in the debited, it will become debit. Okay, however, it is more useful to record all incomes, gains, expenses and losses separately. By doing so, very useful information you will get, and it will which have contribution to the year profit and losses also, because you have information, how much you have earned, how much you have got profit in that year. So therefore you will have some of the information about year's profit and losses. Later the net result of all this is ascertained and adjusted in the capital account. After this, it is ascertained and adjusted in the capital account. Next, expenses are debited and incomes are credited. Keep like that. Expenses are debited and incomes are credited. Since incomes and gains increase capital, gains, it increases capital. The rule is to credit all gains. The rule is to credit all gains and incomes in the accounting concern. In the accounting concern, you have to take all the gains and incomes. Since expense and loss decreases capital, the rule is to debit all expenses and losses. The rule is to debit all expenses and losses. It is. See, of course, if there is a reduction in any income or gain, and that account concerned will be debited. The account you have concerned, it will be debited. Similarly, of any reduction in expenses or losses, the concerned account will be credited. There will be a credit in that concerned account. This rule gives about the summarized. So these rules given above or summarized below. Here you are give some of the summarized, simple in one line. You will know: increase in assets and debits, decrease in credit; increase in liability and credits, decrease in debits; increase in owner's capital and credit, decrease or debits; increase in expenses and debits, decrease or credits; increase in revenue or income and or credits, and decrease or debits. So the term debit and credit should not be taken to mean respectively favorable or unfavorable things. They merely describe the two sides of an account. The debit and credit it describes two sides of the accounting. It describes like that only. You can see some of the illustration they have given, some of the questions they have given. For giving it a debit and credit information, for giving it, let us give it, let us 1 minute, let us stop here. So till here you understand, I think so. Till here what all the information I have given to you, you have already understand it and you have analyzed it, I think so. And till here we learnt about the accounting, debits and credits, bookkeeping, book entry system we have learnt. Now again we are learning debit and credit. Some of the questions now they have given. We are learning by that question. Next some other topics they have given. Okay, one question they have given. Let us finish this. After that we will go to next topic. After this, next is transaction. Next topic is transaction. First let us finish debit and credit. Our topic clearly you have understand till here. With example, let's finish the debit and credit. In this chart you can see they have given an example. First one is or started business with rupees 5,000. He started business. He purchased furniture for 1,200. Paid salary to his clerk as 1,100. For 1,000 rupees 1,100 he paid to clerk. Paid rent 1,150 and received interest 2,000. Okay, first one by one you have to write. Rupees 1,500 cash invested in business. What account involved? Bank and R's capital. Nature of that account: assets, capital, or liabilities or expenses. Next, how it is affected? Increased, because it is increased. Debited means it is increased 5,000. Okay, and credit also it is increased 5,000. Next, purchased furniture for rupees 1,200. Furniture and bank. Furniture and bank. Assets it is both are assets, because debit increase and decrease both are assets, because you are purchasing, you are giving money, and by that you are taking the furniture. So how it affects? Increase, decreased. How means both you are paying assets only, no? So means the money you have got, by that you are paying assets. Next, 1,200 is increased, debited. 1,200 is credited, so therefore it is decreased. Next, paid rupees 1,100 to employees for salary. So salary and bank, expense and asset. It is one is expense, another is asset. Expenses. So therefore the assets means expenses are increased, that is 1100. Next it is decreased, assets are decreased 1100. Paid rent 1150. Rent and bank expense assets, it is increased, asset is decreased because 1150 you have paid, 1150 you have got. Received interest 2000. Cash and interest, asset, income, so increased, both are increased because asset you have paid, you have got income, so 2000 both are increased. Next is transaction. So in the system of bookkeeping, students, you can notice that transaction are recorded in the books of accounting. You will record what all transaction is happened, why it is happened, and for what is the reason of the transaction. In the bookkeeping you will know. Similarly, a transaction is a type of event. A transaction, it is an event which is generally external in nature. It is external in nature and can be determined. So nature, which is general in nature and can be determined in the terms of accounting. Wi-Fi. In an accounting period, every business has huge number of transactions that can be analyzed in the financial terms, and then it can be recorded individually. You can record that what all transaction it has happened, followed by classification and summarization process to know their impact on what your financial statement of that company. To know that impact, it helps. A transaction is two-way process. It is two-way process in which value is transferred from one party to another, from one business company to another. The money is transferred. And either a party receives a value in the terms of goods or other things and passes the value in the terms of money or visa. So like take an example, you are sending a goods to someone, so you are sending them goods, they are giving you money as money or vice versa, they are passing you the value, how much the price there for the product. So a transaction, as you know, if you pass the value in the terms of money, they will give you. There are one therefore one can easily make out that in a transaction. So a transaction is of two, as you know. So therefore, one can easily make out what all transaction it has happened. A party receives as well as they passes the value on other party. For other party, they take the money and also they give to them. For recording transaction, it is very important that they are supported by some documents they should have, like invoices, bills, pay slips, cash memos, passbooks, something they should have for taking this transaction. Transaction analysis is in terms of money and supported by proper documents and or recorded in the book of accounting in the double entry system. To analyze the dual aspects of each transaction, two approaches can be done for doing this. One is accounting equation approach, another one is traditional approach. So till here it is enough. So okay friends, I will explain the other topics of your chapter, the basic accounting procedures and journal entries in my next video. So till here you understand, I think so. So okay friends, I will send my next video. Till then, take care, have a nice day, bye my dear friends.